Here is the illusion. Experts recommend an S&P 500 index fund because it is some secret perfect investment. That is not the real reason. The real reason is more mechanical and more powerful. It is broad, low maintenance, historically difficult for active managers to beat after costs, and simple enough that investor behavior has fewer chances to destroy the plan. But it is still a stock fund. It can fall hard. It is U.S. large cap focused. It is not personalized advice. In this episode of The Finance Illusion, we break the recommendation into data, structure, psychology, and risk.
The S&P 500 is a stock market index maintained by S&P Dow Jones Indices. It includes 500 leading companies and is designed as a gauge of the U.S. large cap equity market. S&P Dow Jones Indices describes it as covering about 80% of available market capitalization. That makes it broad, but not total. It is not every U.S. company, not every global company, and not every asset class. It is a large company U.S. stock benchmark. That distinction matters because many people hear S&P 500 and think it means the whole market. It does not. It is a very important slice of the market.
You cannot invest directly in a market index. Investor.gov explains that an index fund is a mutual fund or exchange-traded fund that seeks to track the returns of a market index. So when people talk about an S&P 500 index fund, they are talking about a fund wrapper that tries to follow the S&P 500. Different funds may use different structures, fees, tracking methods, and trading rules. The index is the blueprint. The fund is the vehicle. A smart analysis separates those two ideas instead of treating the ticker, the fund, and the index as the same thing. The S&P 500 is market cap weighted. In simple terms, larger companies carry more weight in the index. If a company becomes extremely valuable, its movement can influence the index more than a smaller member. This is one reason an S&P 500 fund is not the same as owning 500 equal slices. It is closer to owning a market-weighted map of large U.S. companies. The winners grow larger inside the index, and the smaller positions matter less individually. That structure is elegant, but it also creates concentration risk when a few giant companies dominate the weight. The benchmark advantage is not that the S&P 500 knows the future. It does not. The advantage is that the investor is not trying to guess which one company will become the next winner. The fund owns the benchmark according to the index rules, so the portfolio automatically reflects the companies and weights inside that benchmark. If a company grows into a larger part of the market cap system gives it more influence. If a company shrinks or leaves the index, the structure changes over time. This makes the process rules-based instead of opinion-based, which is one reason experts find it easier to defend.
Many financial educators and professionals point beginners toward broad, low-cost index funds because the logic is repeatable. It does not depend on predicting the next winning stock. It does not require reading every earnings report. It does not require paying a manager to make thousands of judgment calls. The process is transparent. Track a broad benchmark, keep costs low, diversify across many companies, and let time do more of the work. That does not mean the S&P 500 is best for everyone. It means the explanation is easier to defend than most stock-picking stories. One reason index funds keep appearing in expert conversations is the active manager problem. Spiva research from S&P Dow Jones Indices compares actively managed funds against index benchmarks. In the 2025 U.S. scorecard, S&P reported that 79% of active large-cap U.S. equity funds underperformed the S&P 500 for the year. Over longer horizons, Spiva has repeatedly shown that many active funds struggle to beat their benchmarks after costs. This does not prove active management can never work. It shows why a simple benchmark tracking fund is difficult to dismiss. Investor.gov is very clear that fees and expenses reduce investment returns. With two funds holding similar assets, the lower-cost fund generally has more return left for shareholders. This is one reason low-cost index funds are so powerful in the conversation. The manager is not trying to research and trade every opportunity, so the fund can often operate with lower expenses than many active funds. The difference may look tiny in one year, but over decades, repeated fee drag compounds. Experts care about costs because costs are one of the few variables investors can see before the future arrives. An S&P 500 index fund spreads money across hundreds of large U.S. companies and multiple sectors. That reduces single company risk compared with owning only a handful of stocks. If one company fails, the whole fund does not become zero. But diversification inside large U.S. stocks is not the same as complete portfolio diversification. The SEC explains that diversification can happen between asset categories and within asset categories. An S&P 500 fund diversifies within one category, large U.S. equities. It does not automatically solve bonds, cash needs, international exposure, taxes, or time horizon. The emotional reason people like the S&P 500 story is compounding. Imagine a hypothetical investor contributing steadily for decades into a broad stock fund. The power is not one perfect entry point. It is repeated contributions, reinvested growth, time, and staying invested through uncomfortable periods. The math can look beautiful on a smooth curve, but real market returns are not smooth. Some years are strong. Some years are negative. Some declines are frightening. This example is not a prediction of any return. It is a visual explanation of why time and consistency matter so much. Another reason experts like simple index investing is that it reduces the obsession with perfect timing. A hypothetical investor who waits for the perfect bottom may spend years watching headlines, fear, and regret fight each other. A hypothetical investor who contributes on a schedule still buys during good months and bad months, but the process is clear before emotions get loud. This is not a promise that scheduled investing wins in every period. It is a psychology tool. The market will still be uncertain. The point is that a simple rule can stop the investor from turning every news story into a new plan. The S&P 500 is still a stock index. The SEC warns that all securities involve some degree of risk and that investors can lose money. Large company stocks have historically produced strong long-term returns, but they can be volatile in the short term. That is why responsible experts do not say an S&P 500 index fund is safe money for every goal. Money needed soon may not belong in a volatile stock fund. A long-term retirement dollar and a next-year tuition dollar are not the same dollar. Time horizon changes the meaning of risk. 500 companies sounds perfectly diversified, but market cap weighting creates a concentration illusion. The largest companies can represent a large share of the index. If those companies perform well, the S&P 500 can look extremely strong. If they fall together, the index can feel less diversified than the number 500 suggests. This is not a flaw by itself. It is the design. The fund owns the market as the market values it. But viewers should understand that the S&P 500 is not 500 equal votes. It is a weighted system. Another illusion is believing the S&P 500 is global diversification. Many S&P 500 companies sell products around the world, but the index is still U.S. large-cap equity exposure. It does not directly own non-U.S. companies, emerging markets, small-cap stocks, bonds, cash, real estate, or commodities. Some investors may choose to keep things simple with a U.S. large-cap core. Others may want broader global or asset class diversification. The educational point is not that one approach wins forever. The point is to know what exposure the fund actually gives. The most useful way to think about an S&P 500 index fund is as a role inside a portfolio, not as a complete identity. In a hypothetical portfolio, it might serve as the U.S. large-cap stock sleeve. Around that sleeve, an investor may or may not need cash reserves, bonds, international stocks, smaller companies, or other assets, depending on goals and risk tolerance. The SEC's asset allocation guidance focuses on matching asset categories with time horizon and risk. So the question is not only, is the S&P 500 good? The better question is, what job is this fund doing in the whole plan? Index funds often follow a passive strategy, which Investor.gov contrasts with active funds that trade more frequently to seek outperformance. Lower trading activity can reduce some costs inside the fund. Depending on structure and account type, it may also reduce some tax friction, although taxes vary by country and personal situation. This is not tax advice. The principle is simple. The more a strategy trades, the more it must overcome trading costs, spreads, and potential taxable events. A low turnover index process can be boring, but boring can be efficient. The biggest advantage may be psychological. A simple index fund gives the investor fewer moving parts to argue with. There is no daily question about which company to rotate into, which manager to fire, or which forecast to believe. That simplicity can reduce panic decisions, overconfidence, and constant tinkering. The expert case is not that the S&P 500 removes emotion. It does not. The case is that a simple, diversified, low-cost process can be easier to stick with than a complicated plan built on confidence and noise. An S&P 500 index fund may not fit money needed soon, investors who cannot tolerate large stock declines, portfolios that already have heavy U.S. large-cap exposure, or people who need a different asset allocation. It also may not be enough by itself for someone who wants global diversification, bond exposure, income planning, or lower volatility. This is why experts often talk about it as a core building block, not a magic answer. The same tool can be useful in one plan and inappropriate in another plan. The common mistakes are predictable. Mistake 1. Thinking low cost means no risk. Mistake 2. Thinking 500 companies means the entire world. Mistake 3. Buying because recent performance looked strong, then panicking when the cycle changes. Mistake 4. Ignoring the account type, tax rules, and time horizon. Mistake 5. Using one fund name as a substitute for a real plan. A good expert recommendation usually comes with context. A bad recommendation sounds like a shortcut. The finance illusion is strongest when a simple tool gets treated like a universal answer. A clean S&P 500 index fund framework asks 6 questions. What exact index does the fund track? What is the expense ratio? How closely has it tracked the index after fees? Is it a mutual fund or an ETF, and how does trading work? What account type is being used, and what tax rules apply? Finally, how does this fit the full portfolio? Cash, bonds, international exposure, time horizon, and risk tolerance. The answer is never just the name S&P 500. The answer is the role it plays inside a complete plan. The finance illusion is that experts recommend an S&P 500 index fund because it is perfect. The reality is that many experts discuss it because it solves several hard problems at once: diversification inside U.S. large-cap stocks, low costs, transparency, benchmark exposure, and behavioral simplicity. But it does not solve every problem. It can fall, it can be concentrated, it is U.S.-focused. It must fit the investor's time horizon and risk tolerance. The real lesson is not buy this fund. The real lesson is understand why simple often beats clever.